Okay.
We're live.
Awesome. All right. Well, welcome everybody. Good afternoon. Welcome to our live stream. My name is Kinsey Grant, and I am the business editor at Morning Brew and host of our Business Casual podcast. Today, I am very excited to welcome some investing legends from O-Shares doing this live stream with me today. And I'm going to introduce these guests and let them say hello to everybody in just a second. But for anyone tuning in today who isn't already subscribed to Morning Brew, go check it out at morningbrew.com to get all the business, investing, and econ news that you would ever want in your inbox 7 days a week. And now to my esteemed guests, I am very excited to speak with you guys today. We have, first of all, Mr. Wonderful himself, Kevin O'Leary. Kevin, welcome. You are of Shark Tank fame, chairman of O-Shares. Excited to chat today.
Thank you.
And we also have Connor O'Brien, the CEO and president of O-Shares and the brains behind development and management at the firm. Connor, excited to talk with you as well. Welcome.
Great to be here.
Yeah, I'm excited that we're all getting a chance to do this. I know things are a little different. These sort of events that we would have loved to have done in person are all over the computer now, but you guys sound good. Everything looks good. So I'm excited to do our best here in unprecedented circumstances, as everybody keeps saying. But I'm excited to talk to you guys today, too, about investing in ETFs and personal finance. And we've got a great conversation planned. We're going to get started with that. But first, we got a couple things, some programming notes. If anybody has any questions or anything you want to ask me or our guests, feel free to reach out to me. I'm not sure if we have a Q&A here, but if you want to find me on Twitter, I'm at Kinsey Grant. My email is kinsey@morningbrew.com. It's KINSEY @morningbrew.com. And second, let's talk a little bit about O-Shares. The partners in this stream, you guys are obviously doing a ton of great work. Kevin or Connor, would one of you want to intro O-Shares and tell everybody what it does, what you guys are up to?
I'll take a stab at that.
Summary.
We've been partners for a long time. And basically, I'm an investor. And what we've always tried to do is I eat my own cooking. I want to build indices that are good for long-term investing that preserve capital, because I've worked very hard for what I've made and I wanted to produce for me each year. I distribute about 6%. So my bogey is always, how do I own stocks over a long period of time that preserve capital and provide me with income and distributions for around 6%? And that's sort of the way we started. Now, I also want growth. So I'm obviously watching what my Shark Tank companies are doing and all my private investments. And we branched out into some very interesting areas of growth around technology. And we'll talk a little bit about our OGIG index, which captures global internet giants, which has been one of our best performers this year for obvious reasons.
Right. Yeah.
Well, Samantha, our producer could probably put the tickers on the bottom of the screen. I'll just mention we have 4 ETFs that are New York Stock Exchange listed. They're the 4 tickers of them. We have for large cap OUSA. We have OGIG, which for global internet giants is going to be a great thing to talk about today because it's just so much. It's called accelerated by the pandemic. OUSMs for small cap, and then OURs for Europe. And we developed these in part to suit the conservative investment philosophy that Kevin brings to the table.
Right. And it sounds like there really is a lot of something for everybody here when you guys are talking about the products at O-Shares. And I love that these are rules-based, straightforward, profitability, cash earnings, balance sheets. You're talking about all the right stuff. And it's simple, straightforward, easy to understand investing, which I would argue we need more than ever right now. Things are more complicated than we've experienced them in a very long time. So especially now, we want straightforward advice, personal finance, investing, ETFs, you name it. So that's what we're going to focus on today. We're going to try to have a fun conversation here about investing in ETFs and personal finance and entrepreneurship and markets and everything, because everything else is bananas. So let's have some fun and try not to make anything more confusing than it needs to be. Does that sound good?
Yeah, absolutely.
Okay, awesome. So I want to start here with 10 minutes or so of, we're going to call them rapid-ish fire questions. I've got 5 questions here, and I'm going to put some time on the clock on my phone timer. We've got about 1 minute to answer each, so you guys can both answer if you'd like to. If not, feel free to take a pass, but we've got a couple, and we'll see how far we can get in 1 minute of answering. To keep ourselves honest, I am going to set the timer on my phone, okay?
Got it.
Cool. So our first question, how would you characterize the landscape of retail investing today? So 1 minute on the clock. Kevin, you want to go first?
Yeah, sure. Retail investing is going through a massive change. Obviously, retail has been shifted as a result of the pandemic. Many retailers remain closed and the openings are staggered and uncertain. companies have pivoted to digital technology, selling direct to customers. It's not just Amazon anymore. They're using platforms like Shopify, the partnership with Walmart and Facebook, to capture almost 100% of the margins. And this is the extraordinary outcome, the unforeseen outcome of the pandemic. Some of my companies have done incredibly well without retail at all by building up franchises directly with their customers. And that's why the market's so excited. It's America 2.0. It's digital, it's productive, and it has higher margins.
Kinsey, if you were asking about retail investors and how they're putting their money to work, that's also changing really rapidly. And what you see is investing is being made more easy, more efficient, and more cost effective using technology. We actually, Kevin and I created a company called Beanstox, Beanstox. It's in the App Store, and it allows people to invest in a way that follows Kevin's philosophy of diversifying across a selection of ETFs that generate dividends and generate, we think, really attractive risk-adjusted returns. So that's another way that the world has changed, following technology, using technology for apps like Beanstox.
Wow, you guys are good. You both answered in under a minute. Congratulations. You must have been training for this. But you bring up a great point, the technology conversation. I think we can't talk about investing today without talking about the tech products that are at everybody's fingertips. Anybody can be an investor today, which is really, really cool. All right, next question. What role do ETFs play in the landscape of individual investing, and why do they matter?
Look, I'm an individual investor, and what I need is diversification. So the beauty of ETFs, they're tax efficient, they're totally transparent. If you want to see every stock that's inside OGIG, you can just search it, and I love that. But what really matters is the rules determine which stocks are put into the index. And that is a whole new ballgame, because I don't want market cap weighted indices where 2 or 3 stocks end up being 30% of what I own. I want diversification. So rules can make that happen. Maybe put a maximum of 6% weighting, 20% in a sector, or some kind of growth metric. But the rules determine what's in and what's out. I go to bed at night, get a great night's sleep, and the rules determine what I own, and I have tremendous diversification.
Another thing ETFs allow people to do is invest small amounts of money and get incredible diversification along with those small amounts of money. You can invest $5, $10, $100 a week, and in every time you add to your portfolio, have it diversified in the same portfolio as you had the week before. Instead of having to wait till you save up $2,000 to buy one share of this stock, $500 for one share of some other stock. Yes, fractional share investing is coming. That's changing things as well. But just think about it. You could buy $100 worth of a set of ETFs using an app like Beanstox and end up owning hundreds or even thousands of stocks with that $100 per week that you might put into your investment account.
Yeah, another under 1 minute each. Way to go, guys. But yeah, these tools are really interesting. And I think we're lucky to be investing in this sort of a landscape where everything is getting easier. We're making it such that anybody can do it. And you don't have to invest, millions or billions of dollars, like you guys are saying. It could be as small as a couple bucks a week. And that all, as we know, compounds eventually. And you're going to be glad that you started early, I would imagine. But lately, we've been seeing, just in terms of trends and themes in investing, a lot of individual investors going after specific names. We see giant run-ups in something like a Hertz. What are your takes on this? I mean, do you think that these individual investors who decide to pump up one specific name can actually move the stock market in a broader sense, in a more long-term sense? And then second, as a follow-up, what are the implications of this for the stock market, say 5 years or 10 years down the line?
Well, there's a difference between trading and investing. And obviously, there's nothing wrong with trading. Some people do it for entertainment. Some people do it because there's no professional sports around right now. So this becomes the surrogate for it. But it's not investing, in my view. I mean, trying to pick which stock is going to move on any day and buying and selling it multiple times, to me, doesn't sound like a great long-term strategy. And I'm not against it at all. It's just when I'm trying to deploy capital and preserve it and have it generate income for me year in, year out, that is definitely not going to be Hertz. To me, Hertz is a zero. It's dead. It just doesn't know it yet. So why would I ever buy it? That makes no sense to me. I'm really more interested in quality names with something I love to call cash flow. Cash flow. I love the way it just ripples off your lips. Cash flow. Because that's why you invest. You want cash flow.
Right.
One of the things we hope that investors learn from making mistakes is that they keep the mistakes really small. And if they buy something that goes to zero, They still have lots more money that they can put to work in a much more diversified manner. And Kinsey, you mentioned compounding. That's probably the most powerful investment force in the universe. If somebody invested $100 a week from the day they got their first job through to, let's say, 40 years till they retire, if that's invested in 8% annualized return, which is actually something like the long-term returns on the market, they would end up with over $1 million.
Mm-hmm.
That's investing, not trading.
Right. And I'm glad you draw the distinction here between investing and trading. I feel so often they are kind of considered in the same breath, and that should not be the case. All right, we got one more question that I want to ask you guys before we move on to our next portion of the conversation. My question for you is, why are the stock market and the economy diverging so much right now? Does it matter? Is this something you're paying attention to? We see the economic indicators are obviously not as good as they were 6 months ago, but the stock market continues to do okay. I mean, obviously there was a downturn earlier in the year, but by and large, things are humming along. Why is this, and why does it matter?
Stock market tries to determine present values of future earnings. And it's volatile. Obviously, it's up and down every day. But the potential of America 2.0, a digital economy with more productivity and higher margins within the S&P 500, is clearly the focus of investors now. I don't think anybody really cares about earnings in 2020. It's written off. Whether the S&P is $75 or $100 or more or less, doesn't matter, because they're looking past the results of shutting down the economy, which was extraordinary, what we did. And it's different than a typical recession, which is a slow grind over 6 quarters down to a bottom. This was a weekend. We turned off the economy in 48 hours, and the pent-up demand remained, and you can see the consumer coming back. We don't know the outcome of the whole COVID thing, but you can, I look and I'm very optimistic to watch countries like Switzerland with 8 million people, so a good-sized American city, having new cases today of only 17 because everybody's adopted a mask. I'm sure we'll figure this thing out even without, some kind of mass inoculation. But it's the potential of what we've gone through in digitizing the economy and compressing this conversion from what would have been 3 or 4 years down to 4 or 5 months. And I really like what I see, and I think other investors are in the same boat. That's the disconnect. All-time highs on the NASDAQ, all-time highs are close to it on the S&P and the Dow. It's because America 2.0 looks really attractive.
Yeah,
something else that's really helped, Kinsey, is what's come out of Washington. Not everybody likes Washington, but the Federal Reserve Bank poured trillions of dollars in. Congress and the administration poured trillions of dollars into the economy. And that liquidity, a lot of it is finding its way into the stock market. So the retail investors that you were asking about, as well as through all the other institutional investors that realize that liquidity does float most boats.
Right. And I think it's a great point here, Connor, that the economic relief package that Congress passed, everybody talked about how big it was, $2.2 trillion is a lot of dollars, but it was even larger than that when you take into account all of the stimulus that the Fed engaged in early on when this first got started. All right. I feel like that was a ton in, about 15 minutes. So way to go. We are right on track to give people the insight that they want in a rapid fire situation. So thank you. We're now going to move on and do a little bit of debate. So in the spirit of trying to be concise here, we're going to have short little debates here, just a couple of them, maybe 2. I'm going to give you guys something to debate. You're each going to get about 2.5 minutes to state your argument. But here's the thing. Whoever goes first gets to pick the argument that they want. And then the other person just has to take the other side of the coin.
And
cool.
Kinsey, let people know the second debate, it's going to be you against Kevin.
Okay, yeah, Connor's going to come up with something for Kevin and I to debate. So I hope you're thinking of something, and I hope it's something I have an answer to. I know a lot about podcasting. Okay, so the first one, I know that this might be, you probably are going to both want to take the same side, but I'm going to have you do growth versus value stocks.
Yep. All right, I'll go first. Value has just not worked for a long time. And it's probably because we have interest rates next to nothing. And the economy right now is being driven by a whole new metric around digital technology, with some companies growing 25, 30, 35, 40%. So obviously investors want to catch that wave. They want that trend, and they want the engine of the economy, which is basically growth technology. And I don't see that changing anytime soon. It would be very hard pressed for me to take my money out of growth right now and put it into value when I know the entire transition that's occurring is going to take 2 or 3 years. I want to be part of that wagon of technology change right through the whole piece. Then after that, if rates get back up to maybe 4 to 6%, I'll start to look at value again.
All right.
Here's how I'm going to dance around that one. There are 3 categories. There's growth, there's value, and there are dividends. And people used to buy value stocks as an alternative to growth, thinking it was defensive. So my play is dividends. And I want to own the stocks that have great balance sheets, great profitability, and pay dividends, grow their dividends. That's, of course, a description of the rules that go into or drive the portfolio of our ETF OUSA. And it's a fantastic alternative to growth and alternative to value for people who want something a little bit more resilient going through a recession when growth may or may not take off.
All right. I feel like that was a smart workaround. I will allow it. So we'll have everybody weigh in, maybe put something in the comments if you think one or the other made a more compelling argument. And Connor, I guess it's now time for you to pit me and Kevin against each other.
Okay, I'm going to give you 5 questions. You're going to get 10, 12 seconds each. Who's your favorite shark, Kinsey?
Well, I can't say Kevin because I feel like that would be a little bit unfair. But I actually interviewed both Mark Cuban and Barbara Corcoran for the podcast. I have to say that I probably vibed a little bit more with Mark. I think that we just had a lot of fun. We talked in a podcast that was scheduled about 2 hours before we did the recording. So we didn't have a lot of time to prep, didn't have time to be stressed, and we had a really fun time.
Well, I know who my favorite shark is. It's Mr. Wonderful. I love that guy. I love working with him. He's the best shark.
Okay, sports question.
Ooh.
Which pro sports league is the first one, going to be the first one to come back and play a full season?
A full season like they used to play?
Yeah, and it's not ladies first on this one. It's Kevin first.
I think it's going to be the PGA Tour, golf.
Smart.
All right.
Kinsey.
Well, I know that the NBA is coming back end of the month, right? But I don't think it's going to be a full season. But I do think there's a lot of promise in the idea of just quarantining the entire league in one specific place and seeing what happens. Like the Olympic Village, but for professional athletes.
Here's a stock question for you, Kinsey. I hope you know the company Shopify. It's now 100 billion market cap. And many people are saying it's going to be an Amazon killer or at least an Amazon challenger. Which stock do you think is going to be up the most between now and year end, Amazon or Shopify?
Shopify.
Why?
I think Shopify because, first of all, I really admire Shopify leadership. You know, obviously Jeff Bezos is a genius and someone who I admire very much, but Toby Luckey is an incredible leader in my opinion. And I think that Shopify has the advantage of being a little bit of an underdog compared to Amazon right now. The momentum is in their corner too, which I think should not be discounted.
Kevin, I know you use Shopify across your 50 plus companies. Tell us your thoughts on this.
Yeah, Shopify is probably going to win. I have to agree because they allow you to keep a direct relationship with your customer, something Amazon doesn't. It doesn't mean my companies don't want to work with Amazon. Indeed, across the portfolio, it's 40% of our sales. But all our new business that we've taken away from retail because it's closed has gone to Shopify with its new partnership with Walmart and Facebook. And we're building our own platforms using tools like Wix. All the companies inside our OGIG index are the ones that are allowing this digital transformation direct to customer at way higher margins. So Shopify is at the heartbeat of that. I don't see that trend changing in the next 3 years. It's going to be a kind of a Shopify versus Amazon world. And if you're starting out and you want your customers, you're going to rather be on Shopify.
Connor,
Kevin, you touched on OGIG. I'm just going to give a layup to Kevin. So you got old tech and new tech. Let's say old tech is represented by the NASDAQ 100 and new tech is represented by our ETF OGIG. Which one's going to be the winner between now and year end?
I think it's already predetermined. OGIG is looking like it's really going to be a very, very strong performer. I wanted to make one point that there is a stock in the world, and it's unique, Microsoft, that you find in conservative index like OUSA, which is a dividend strategy, and you find it in OGIG, which is a growth internet giant strategy. What a remarkable company that it can post 15 and 20% growth at a behemoth size. There's no other company like it. And that's a dino tech company that's gone through transitions.
Kevin, what do you think it is that gives Microsoft that special something to be both a dino tech company and one that is still considered a hot investment right now?
It's the standardization upon all of their work tools. All of my companies standardize on what Microsoft has on its platform, from the PowerPoint to the Word to the Excel spreadsheets and the cloud services. We all use that because we need the commonality of that single language. And that's not just domestic. My international companies are the same. That's not going away. It's going to be very hard to take that away from Microsoft. And the innovation keeps coming. Every quarter, the tool sets get better and more adapted to the cloud. I really have to hand it to them. I've been a shareholder for decades, but it's been the last 4 years that have really rocked in terms of what they've done. They've come out of nowhere as a Dynotech company and now lead the charge in many, many aspects of what companies need just to do business.
Right. All right, Connor, any more questions for us?
I think we're going to score you as the winner. You won 2 out of 3. We're going to just spare Kevin any more damage.
I know you might just be doing that to be nice, but thank you. I'm going to put it on my resume. Okay, well, I think we've gotten some good investing stuff. We've gotten some good ETF stuff. We've talked a little bit about some specific companies. Now I would like to shift gears and talk about some personal finance. Does that sound cool to you guys?
Great.
Yeah.
Sure. So, okay, number one question here, and we can just chat. I'm not going to put a timer on. We still have some time left on our clock here. How should the recession that we're entering into impact someone's personal finance? Let's say, someone like me, someone in their 20s who still has a job right now. How should we be thinking differently about personal finance because of the economic situation in the United States right now?
Kevin, if I can just kick off with a statistic that I know you're going to build on this a lot. There are over 100 million households in the United States that have virtually no investments. So there are 100 million households that need to get it together. And they should be starting now. Whatever day now is when they should be starting. Now, Kevin's got much more time-sensitive comments. I'm sure he'll be layering on top of that. But it's so important for these hundreds of millions of people to get rolling.
Okay.
What I found through the PPP process in helping my companies get the government loans in the first batch and then the second, as we were concerned about our employees and the PPP allowed us to keep them at full comp, I learned something stunning. The majority, including my supply chain, which include thousands and thousands of people, primarily in their 20s and early 30s, practically none of them has put anything aside for the future, which stunned me. Obviously I couldn't have known that till I found out how stressed they were in terms of living week to week on paychecks. Everybody listening right now has to know you've got to put aside at least $100 a week into some kind of investment vehicle, because if you start now in your early 20s, you'll have over $1 million by the time you hit 65 and something to live off, just if the market continues to give its traditional 6 to 8% a year return, which it's done for decades and decades. There's no guarantees, but you have to have some strategy, and to have nothing in the bank is crazy. That's right. Why I've gone into the whole beanstalks. I'm an investor in that. I'm on a mission over next year about financial literacy. I'm pounding the table in high schools along with other sharks. We think people learn everything else in high school, debt, geography, reading, math skills. They don't talk to them about investing. That's crazy.
Right. I agree. And I am 100% a proponent for financial literacy. My big question here, though, is do you think that the lessons from the older generation can still be applied to someone who is in their 20s, is buried in student debt, is living paycheck to paycheck? Can we use the same strategies?
Yeah, absolutely. The key is it's very simple. My mother, when she was in her early 20s, taught me that she would take 10% of her paycheck. She was a working girl, and she put it aside. When she passed away, she was one of the most wealthy women in our entire family because she simply bought dividend-paying stocks. And in those days, she used to love telco bonds. But her portfolio, she kept a hidden portfolio from everybody, including both of her husbands, because she wanted her own financial independency, and she got it. And I was amazed when I learned as the executive of her estate what she put aside. Everybody has to do that. Every generation has to do that. Today, it's a minimum of 100 a week. Everybody can do it. If you've got a job, you can avoid buying that crap you don't need and save 100 a week and put it aside and invest for your own future.
What do you think the telco bonds of today are?
Say that again?
What do you think like your mother invested, you said in telco, what do you think that investment would be today for somebody who wants to start a fund of their own?
Remarkably, telco is now communications, and they do belong in people's portfolios because of how important the internet's become. It's morphed into something else because people can't continue on to communicate. But I think using exchange-traded funds, and that's what Beanstox does, it doesn't even use our ETFs. We're just trying to get people to have diversification and own high-quality stocks and own them over a long period of time and invest incremental amounts of $100 a week into a massive diversified portfolio. And we've made it really easy. We completely rewrote Beanstox so that it would become incredibly simple to use. And now I'm just running around pounding the table, getting people to try it. You can download it off any app site and check it out. But if you don't have a strategy to invest, that's a really bad outcome.
All right. So
Kinsey,
my next
if I could just add one thing. You mentioned debt and student debt and credit card debt, and debt is awful. People need to try to get away from it. However, the longer they procrastinate on getting their investment plan started, the tougher they're making it for themselves to retire with a decent wealth base on which to then live. And so some degree of balance is healthy. Cut the crap that people spend money on. If you don't have money to pay down your debt, you better not be wasting money on expensive little gadgets. But do start investing. And now it's possible to start small. You talked about older generations. The older generations never had the tools that are now available. So they're not going to be able to educate the younger generation on how to get started. Go to the internet, read, learn, take a look at Beanstox, take a look at whatever else you want. But I would just encourage people to get started, even if they're still chipping away at that student debt and any credit card debt. God help them if they got into that.
Yeah, just do it. All right. That seems like a solid enough answer. All right. So my next question here, how much do you recommend people have in an emergency fund? So let's say a rainy day fund for you lose your job, things go awry. How much do you need to have in the bank saved? What's the goal amount?
Minimum 6 months of your salary after tax, because poo-poo happens in life. All kinds of things happen and you need time to pivot. I like to have a year's worth if you can, but minimum 6 months. This 2-week stuff is crazy. I mean, you don't know what's going to happen. Whoever saw the pandemic coming? That's my whole point. You need enough that you can regroup, pivot, and move forward. That's 6 months minimum.
All right.
And the 6 months gives you time to find the right job. 2 weeks makes you panic and you become a waiter. Not that there's anything wrong with that, but if you've already got an education and so on, and you've been in some sector with a high-paying job, and you got to go find a job in a restaurant, washing dishes or whatever it is, you're going to be in the wrong place and harder to find that right job after. So give yourself time to breathe, refocus, and find a great job. And
find a job that you have the appropriate skills for and that appropriately uses the skills that you already have. All right. So our next question, if you guys were starting a side hustle today, what would it be?
If I was starting a new company today?
Sure, yeah. Something that's outside of your typical wheelhouse.
You know, I always tell people that ask me this question day in, day out, solve a problem for one person that everybody has, and it can't be anybody in your family, and you've got a business, because that's what great businesses are all about. What I would be looking at right now is, I think, and I bet you this is going to be one of the themes that we see in this season of Shark Tank, the people's propensity to be worried about their health now has never been higher. What you eat, how you live, what you weigh, how you exercise, these are all areas where new people and old people and young people, I don't care what your age is, they're very interested in. And I think any business that focuses on self-improvement in any of those areas is going to be one I want to invest in, because I know those trends. Just the trends on food alone, I bet you I'll be investing in some very interesting food groups that are very good for your health in this Shark Tank. And I want to, because I see that. So I'd probably be moving into things that help you live a healthier life and do it all online, sell everything direct to customer. That's it. I wouldn't touch retail.
Here's an idea for people that almost everybody could probably implement themselves. Education. Find something you're good at that other people would like to be good at, and go online and create a channel like the channel we got today. It costs almost nothing to set it up, and just get it started with friends, family, and others. Social media, attract them to your education, whether it's a language education, math, science. gym, some sort of health workout related, restaurant choices when restaurant choices start to matter, food choices would always matter, personal finance education. There's so many different categories, and almost everybody has at least one thing that they're pretty good at.
Right. And I got some advice from someone on a podcast episode before. It was just ask your friends what you're good at. Ask 10 of your friends. If you came to me for advice, what would you be asking about? What is my skill that I have that other people don't? Which is an easy thing to do. Just go do it. All right. We're going to have one final question here. Kevin, this one's geared a little bit more toward you. On Shark Tank, and I asked this of Barbara as well, who of the other sharks would you want to switch portfolios with? If you had to pick one.
Switch portfolios.
You take all of their investments.
Oh, that's a real tough one. First of all, I want to say something nice about Barbara. The only reason that she makes it to Shark Tank on time is I bought her a new broom. Listen, I get along very well with her, but you know, here's the thing I would say about that idea. It's a very cool question, but over the last 11 years of making Shark Tank, people know a lot about the shark that they're interested in co-investing with. In other words, they come on saying, I want to do a deal with Mr. Wonderful. I want to do a Cuban deal. I want to do a Damon deal. I want to do a Barbara deal. We have become specialists in certain areas. I own the wedding space. I own the gifting space. I own the food groups area and on a lot of technology as well. I've got an extremely diverse portfolio. It's not just gathered around one sector. And so I'd want to keep what I got. I'm really happy with my returns. Not everything's perfect. But, you know, not that I want to boast the outcomes, but the largest deal in Shark Tank history was the sale of Plated to Albertsons, a food-based plated deal, if you remember. They were sold to Albertsons after Amazon bought Whole Foods, but Plated was sold for $340 million. That's my deal. There's never been one anywhere near that size. I try and find great entrepreneurs that have a vision and a desire to win and back them. It's really about those people and how they work. That's the key to success. Back the entrepreneur, and then you'll make money. But no, I wouldn't switch my portfolio. Not going to do it.
Just walk away. All right. Well, thank you guys so much. Those were some really fantastic and insightful answers. I'm grateful for you taking the time. Looks like we may have lost Connor there. He appears to be gone from my screen. But Kevin, thank you so much.
That was great. You're doing a terrific job. Keep it up. That was a lot of fun.
Thank you. Yeah. And if anybody has any questions, reach out, let us know. I'll check back here in the comments and try to get back to as many people as possible. But thank you so much for tuning in. I hope everybody enjoyed it as much as I did, and have a fantastic afternoon.
Take care.
Thanks. Bye, Kevin.